Today's November 28th. I'd like to welcome Justin Blesey, Executive Vice President and Asset Allocation Strategist in PIMCO's Newport Beach office. He focuses on multi-asset strategies and customized client portfolio analyses and is the lead product strategist for PIMCO's model portfolio business. He's got 16 years of investment and financial services experience, and his undergraduate degree was from Dartmouth College, and his MBA from the University of Chicago Booth School of Business, CFA charter holder, and now on a Zoom call with me. Welcome, Justin.
Thanks, Simon. Glad to be here.
What I want to do is have a conversation with you about bonds today, of course, being from PIMCO. This is from a retail investor's perspective. And if I could ask you, could you just introduce PIMCO to me very briefly?
Sure. PIMCO is an asset manager that has been based in California, but we're a global firm for over 50 years. We manage across all asset classes, but we're primarily known for managing bond portfolios as well as alternative portfolios.
It's interesting because when I started in the industry in the 90s, when it was the heyday of the bull market, a client had asked us about bonds, and my boss was saying, bonds, I'd rather stick a fork in my eye than buy bonds. And, it turns out that that was probably the top of the market in the 90s. So he was almost absolutely wrong, to tell you the truth. But we're back to a point where fixed income is starting to look really, really interesting. And I wanted to ask you, first of all, what is a bond? How would you define a bond?
Yeah, so ultimately a bond's a loan, whether it's an individual, a corporation, or a government. They're receiving that money up front to make some sort of investment in the future. So that's an individual taking out a mortgage to purchase a home. That's a government building infrastructure. That's a corporation expanding operations. And as compensation for that money up front today, the borrower pays back not just the principal, but the interest, and that's the return for the investor. So unlike equities, bond payments are fixed. So outside of a default, importantly, bond payments and bond returns tend to be much more certain and predictable than equity returns over time.
So an equity itself, you are owning a company, but a bond is more like a contract with a company.
That's exactly right. And the mortgage is a great example. You're just on the opposite side of that. So instead of paying your mortgage with interest every month, you're receiving back as an investor in a bond some of that principal as well as the interest and compensation for providing that money up front.
What would you say is the role of bonds inside of a regular person's portfolio?
Yeah, so we usually think about it as having three primary benefits for an investor's portfolio. And the first one you hit on, which is just returns, right? That's the one we think about with most asset classes, mostly equities, right? You want a high return over the long run. And bonds provide total return as well. Importantly, they also provide steady income as part of that return. Much of a bond's return tends to come from the income that it generates. So it's kind of a nuanced point on return in terms of the way that you see your returns in a relatively stable fashion, especially if you need to meet certain spending needs. That's more the obvious one, is return. The second is diversification. And your example of the late 90s, early 2000s is a good one. Bonds, over longer periods of time tend to be pretty lowly correlated to equities. That means when equities in particular are selling off, if they're doing poorly, oftentimes bonds are rallying. So from an overall portfolio perspective, that's a benefit, right? It's performing well when something else in your portfolio is performing poorly. And lastly is capital preservation, i.e., in the last 2 years, kind of notwithstanding, no negative returns, right? In most environments, bonds tend to have positive returns overall, maybe lower overall returns than equities, but they tend to be more positive over time. So they tend to do a better job of preserving capital, preserving your principal, over longer stretches of time.
So it's interesting because you're talking about preservation of capital, preservation of principal, making income. Yet last year we had probably the worst year for bonds that I've seen in my career. And so many bond funds lost money last year. So as far as capital preservation and income, it kind of went out the window to a large extent. Could you comment on what happened last year and where are we today?
You're right that last year was pretty much the worst year for bonds in the last 40 years. That's for a few reasons. One is that starting yields going into last year were pretty low, nearly historic lows, both in terms of very cash deposits and things like that, as well as just bonds with longer maturities as well. On top of that, we had pretty high inflation overall across the globe, across most developed markets in particular, that haven't really experienced high inflation, unlike emerging markets, in quite some time. And what that typically leads Central Bank of Canada, the Federal Reserve, other central banks to do is to start to increase interest rates. And why they're doing that is because ultimately, and it sounds maybe a little counterintuitive, or it's not necessarily a positive outcome in some respects they're going for, they want to dent demand. They want to slow growth. And if they raise rates, the borrowing costs for individuals, for corporations, for governments go up. They're likely to end up borrowing less and therefore buying less and stimulating the economy less. That hopefully the Fed and Central Bank of Canada and other central banks hope will lower than inflation. So they're looking for one good outcome, rising rates, increasing rates to lower inflation, but unfortunately at the expense of lower growth. And because they were so far behind, inflation was so high last year, they had to increase rates at an unprecedented rate. Just take the Fed, for example, in the US. The increase of about 4% we saw in terms of Fed funds rates, in terms of what the Fed holds out as borrowing costs, that increase was basically the 98th percentile over the last 50 years. A very unprecedented move in terms of both the speed as well as the aggressiveness of the hike. And unfortunately for bond investors, in terms of a pretty standard relationship, as yields go up, bond prices go down. And so because yields started from a very low starting point, there was very little cushion there in terms of blunting that increase in yields. You saw pretty negative returns in bonds last year, even in the double digits for high quality bonds, which is pretty much unprecedented in the last 40 years. The flip side is, and I know we'll talk a little bit more about this, is that higher starting yields tend to correlate very, very closely with better future returns. So now that yields on not just cash deposits, but also most bonds are kind of in that 5% range, that's a much better anchor point in terms of what you can expect over the long term for bonds to return going forward. The pain of last year turning into hopefully the gain of future years.
Right now, we're at a situation where yields are much higher as a starting point. Now, if growth stays high for some reason, what would happen to interest rates, do you think?
So it would kind of depend on what would happen to inflation at the same time. So we go back to that relationship we talked about. The Fed is largely trying to dampen down inflation, as are other central banks like the Central Bank of Canada. If you have stable growth and attractive growth, but inflation continues to stabilize, it's very possible that many central banks are done hiking. You may not see another hike from this point in time. Now, if growth still remains strong, though, they may just hold rates where they are for longer. That would not be a bad outcome for bond investors. In some ways, you're just clipping a coupon of 5%, a very attractive starting point for a relatively low volatility or low risk asset. If growth accelerates, like it did in the US in the last quarter and continues to surprise to the upside, and that leads to more inflation, or inflation that doesn't come down nearly as fast as central banks would like, then there is a real possibility that they will have to hike again. Now, we wouldn't expect another 4% of hikes over a 12-month period. We wouldn't expect, what is now 5% borrowing costs to go all the way to 8 or more. But it is possible if they in that situation, it might not be another 25 basis points or 0.25%. It very well could be another 0.5% or 1%. The difference, though, is because starting yields today are 5%, those subsequent increases are not nearly as painful from a total return perspective as they were when starting yields were 0% in terms of cash rates or 2% in terms of 10-year bond rate.
Going from 5% to 6% will not hurt as much as 0 to 5. That the orders of magnitude will be completely different. Now, what happens if growth declines from here? If inflation cools, what do you think would happen in fixed income markets at that point?
So in that environment, likely what would happen is that the Fed, Central Bank of Canada, other central banks can feel that they can start to cut rates at the front end. And what that means is that the market will anticipate that. Part of the reason, not just 1-month treasury bills, but also 2-year treasury bills and 5-year bonds and 10-year bonds and 30-year bonds are at 5% is because that front end is at 5%. If the Fed starts to, and other central banks start to bring down those front yields, the other yields at higher maturities, the 2-year rate will come down, the 10-year rate, the 30-year rate, which is what many mortgages in the US are priced off, that'll come down as well. The net effect, though, is very interesting. The impact and the price appreciation that you get for bonds that are, let's say, 10 years or longer maturity than kind of cash rates that we spoke about is very powerful in a positive direction. It's almost the reverse of what happened last year. Because last year, you had really meager starting yields, rates rose, and so you had a lot of price movement moving against you to the tune of -10%, -15%, even on high quality bonds. Well, the opposite could work in your favor going forward. If rates rally another percent, even just moving from, let's say on the 10-year point, 5% to 4%, that is going to equate roughly to about a 5% gain in terms of a bond like that. You don't get that reaction for cash rates or deposit rates. Yields coming down just means lower return. So if you think about it, you start the year at 5% with cash rates, 5% on the 10-year bond. Let's say yields decline 1% in both cases. Well, your return on cash goes from 5 to 4. You're just by definition making less. Your return on bonds is 5% coupon plus another 5% return, more like 10%. And that's what I think many advisors, many clients are starting to realize is that movement that hurt so much last year really could start to work in our advantage this year and are starting to really think about moving outside of cash back into bonds before that move fully materializes.
That was one of the questions that I had to ask, which was, many people, of course, right now are looking at cash rates and seeing, hey, I can get 5% on my cash. Meanwhile, they can get 5% on their bonds. Why wouldn't they keep the cash? Why would they want to have bonds? And basically, if I'm just to summarize what you just said, that your longer term bonds go up in price. So not only do you get the coupon, but you get some capital appreciation potential there as well.
Yeah, and another way to look at this, there's another angle there to look at this too, which is we view cash as more of a tactical move, or you need it for spending needs. Like you just need to put that down payment on the house, or you're going to be paying off something coming up. Over long periods of time, bonds outperform cash the vast majority of the time. Over rolling 3-year windows, bonds outperform cash about 90% of the time, close to 90% of the time, and beat cash by about 2.5%. That's a pretty healthy advantage over longer periods of time. And in many cases, that means that cash is not going to win. Last year was the exception. There are other periods that'll be the exception. But in the long term, you want to be, we think, fully invested outside of cash needs that you really need for near-term spending.
Lending money. So talking about bonds being contracts where we're lending money to either corporations or to governments. There are different governments and different corporations that have different types of risks. I would think that lending money to Apple or Berkshire Hathaway would have a different risk than lending money to GameStop. Could you tell us a bit about the differences between different kinds of bonds and what
Sure, and I'll
opportunities might be there as well? The opportunities are important as well.
sure, and I'll go back to those three kinds of borrowers I mentioned at the beginning. So governments, right, corporations, as well as individuals, right? We talked a lot about one of the two main risks in bond investing, which is interest rate risk. If yields move up, prices go down. If yields move down, prices go up. And that's true for all those kinds of bonds I just mentioned. The other major risk in bonds is credit risk. Will I get my money back at the end? I loan you $1 million. Will I get that $1 million back in 5 years or 30 years or whatever the maturity is? And that does definitely vary across borrowers, right? Developed governments like Canada or the US tend to have very high credit ratings, very high credit quality. They're pretty much always paying back on time, on schedule. Now, the compensation for that is maybe a little bit less, because if you, let's say, loan to a borrower that is riskier, like a GameStop or a corporation that maybe is having some difficulties in terms of their business, you as an investor will often demand a higher compensation for that, a higher yield, a higher total return for taking on more of that risk. And so that's an important thing to look at. That's something that, when I mentioned earlier that we're the largest active fixed income manager, that's something we spend a lot of time doing here at PIMCO, which is going borrower by a borrower and assessing their ability to repay against the compensation that we're getting for the additional risk we may be taking on. So that's how we tend to think about it. There tends to be the interest rate risk, common across all bonds, and then credit risk, which varies depending on the borrower, corporation, a government, or an individual.
And one of the things that was amazing, one of the biggest wins in my mind, I remember coming out of the credit crisis, PIMCO was able to identify a huge opportunity in the mortgage markets when they got really hurt with the problems that were happening in real estate markets in the United States 15 years ago or so. Right, like could you talk about what types of different types of bonds there are, because that mortgages are like bonds as well, and also whether or not there is an opportunity in that kind of arena today?
Sure. If you go deeper on some of the individual borrowing, one of the biggest segments of that is the mortgages, as you noted, as well as other what we call securitized assets, consumer credit card debt, auto loans, things like that. But let's stick with mortgages for a second. So with mortgages, we do see there to be a very large opportunity there, particularly in US mortgages. A little bit different than Canada. Most borrowers here have fixed rate 30-year mortgages. A lot of those mortgages were refinanced or originated in the last few years before the rise in rates, so they're very low yielding. There's very limited likelihood that U.S. borrowers will prepay those loans, if they took out at 3%, and mortgage rates today are between 7 and 8%. So kind of that interest rate risk component, that's kind of, I don't want to say fully off the table, but it's unlikely you get a lot of those borrowers to prepay. And then from a credit risk standpoint, a lot of the agency mortgages here in the U.S. are government backed. So you on that credit risk side, you essentially have the United States government standing behind many of these mortgages at the end of the day. And from a compensation of risk standpoint, we actually find these to be quite attractive today. The additional yield or the additional return potential you're getting for these mortgages is at some of the highest levels we've seen over the last decade. So a little bit different than what we talked about, you mentioned in terms of the financial crisis. That was also kind of an evaluation of both interest rate and credit risk. There, we were looking at some of the what were legacy subprime loans, the ones that were maybe given to some of the borrowers that were lower quality. But when we looked at some of these loans a few years after the crisis, they were still being repaid. And if you could live through the whole crisis and still be credit quality good or money good to be able to repay your loan, we thought there was very attractive compensation in terms of the yields and return potential offered there for what seemed like actually a pretty decent quality borrower minus the name or the kind of legacy reputation of those loans during the crisis.
Just to kind of switch gears back to interest rates and where they are, where do you guys see rates going in the future?
So we would likely see, at least for into the next first quarter or two next year, if things continue the way they are, many central banks probably being on pause, right, and being very happy to be on pause, so the rates staying the same. They want to see that some of these higher borrowing costs are filtering through to the economy and having the desired effect of continuing to lower inflation, albeit at the expense likely of lower growth. So that would be our base case. Now, rates can't stay this elevated, we don't think, for forever, right? These are contractionary levels that should have an impact on the real economy in terms of lower growth. And when you start to see that materialize, and it could be as early as maybe the second half of next year, it's possible that you start to see some of these central banks starting to cut rates. We would say the market may be getting a little bit ahead of itself right now in terms of how many rate cuts it has kind of priced in for next year. So we maybe think it's a little bit aggressive for how much is priced in. That being said, if the base case proceeds, even if it's not a soft landing but a soft-ish landing, you could see rate cuts as early as the second half of next year. The one risk we would point out is, there's kind of two risks in opposite directions. One is if inflation doesn't moderate as desired. It's easy to go from 8% inflation to 4% inflation. It's very hard to go from 4% inflation to 2% inflation that many central banks target. If it remains persistently at, say, let's say like the 3 to 4% level, you may see the Fed stay a little bit longer at the current rates, or Central Bank Canada at the current rates that they're at, or even potentially hike a little bit, like we mentioned earlier. Again, not another 4%, probably another 50 or 100 basis points. The opposite could be true too, though. We like to say monetary policy and all this tightening happens with a lag. And we may not have fully seen all the effects of these higher borrowing costs come through to the economy yet. And so if you get a harder landing on the growth side than anticipated, you could actually see many of those cuts pulled up sooner because inflation would likely fall relatively rapidly along with a very rapid decline in growth, a more traditional kind of recessionary environment.
Do you see any political risk in the United States, insofar as being unable to pass a budget? Do you think that might impact the credit rating of the U.S., and would that impact, therefore, long-term rates or short-term rates or rates at all?
It is possible. I mean, if you go back to, for example, sometimes it can be counterintuitive, though. If you go back to some of the budget similar issues that were faced in kind of the 2011, 2012 range in the U.S., counterintuitively, there was a market reaction, but it was a flight to quality, and yields actually rallied. You think, as you mentioned earlier, that credit risk concern might actually send yields higher. It was the opposite. I think what we're likely to see, or our base case, is a continuing kind of kicking the can down the road. And even with the new speaker, we've seen that happen yet again. Exactly what kind of got McCarthy, our prior speaker, removed is exactly what his subsequent replacement did, to kick it into early next year. And, in an election year, even if you get a shutdown, we think it would be relatively short-lived given some of the blowback you'd likely see. So possible effects on the markets, right? 10, 20, 30 basis points, or 0.1, 0.2, 0.3% impact on GDP if you do get a shutdown, but not something that is overly material compared to some of the other risks that we just talked about.
Now, I have a question on my mind that we didn't discuss prior to talking here today, but the Canadian versus the U.S. dollar. Do you have any thoughts on where that would go? Oftentimes, that's an interest rate differential. Interest rate differences have some function to do with that. Do you have any comments on the difference between U.S. and Canadian currencies and what might happen in the future?
Yeah. So one thing I noted about kind of growth slowing, inflation cooling, we didn't talk about is the differential between the U.S. and Canada and how fast that might happen. we do see the potential that the Canadian economy is a little bit less resilient than the U.S. economy. If that proves to be the case, and let's say the Central Bank of Canada can cut rates faster in Canada, that would likely strengthen the dollar because your money goes a little bit further here with the higher rate differential overall. The other thing we'd point to too, which unfortunately works in the favor of the dollar too, is that traditional flight to quality in a really bad risk-off environment, right? So those could push the dollar, at least in the near term, a little bit stronger versus the U.S. dollar, a little bit stronger versus the Canadian dollar. But we wouldn't be overly worried that it would be a significant or severe move, because generally we think of the U.S. dollar as being relatively rich or relatively expensive today in the long run versus many other currencies, both developed and emerging markets. So there's an upper level to how much richer or how much stronger the U.S. dollar can get.
Is there anything that you see that you think would be good to mention to our clients just in general?
Yeah, I think it comes back to that conversation of, where do you go from here with your portfolio, right? You just saw one of the worst bond markets in terms of returns last year. The funny thing is many of us have been trained well on the equity side to buy the dips. Right, you see a big sell-off in equities, great time to buy. Let's put money into it. But for whatever reason, and maybe it's that stability that bonds are, expected to have, any negative return in bonds is often viewed with scared, and skepticism in terms of why would I move money back in. The reality is that yes, on the equity side, generally, if you see a large correction historically, you've done generally well in terms of a rebound over time. Maybe not right away, but over time you have. So there is some intuition behind that rule of thumb. But nothing's guaranteed in equities. The reality is in bonds, I'm not going to say guarantee specifically, but that future bond returns, like I mentioned earlier, are very strongly tied to starting yields. So it's even stronger the case that when you see yields rise in bonds, especially for high quality bonds, which is what we're tending to emphasize here at PIMCO, ones with less credit risk, less chance of default, you now have an opportunity that hasn't been the case in 15 years, we think, in terms of higher future return potential for bonds, given those starting yields, given the fact that the Fed and other central banks are closer to the end of the hiking cycle for sure than the beginning, giving you that future price potential. So we know behaviorally, we see many clients getting, worried when they see negative returns on bonds, but you should think about that buy the dips mentality in equities. That tends to be a good time to be buying into bonds as well.
Wonderful. Justin, as always, it's great to talk to you. Thank you very much for spending some time with us today. And we look forward to the next time we get to speak.
Thanks again. Appreciate you having me.